traders, and welcome back to another episode of Market Vision. If you've ever entered a trade based on what looked like the perfect order block, only to watch price slice straight through it, you're not alone. The truth is, most traders don't lose because they can't find order blocks. They lose because they're trading the wrong ones. An order block is much more than a candle on your chart. It's a footprint left behind by institutional traders, a clue that reveals where smart money entered the market. But unless you know exactly what separates a high-probability order block from a weak one, you'll continue taking low-quality setups that offer little to no edge. In today's lesson, we're going far beyond the basics. You'll learn how professional traders identify valid order blocks, understand the psychology behind them, recognize different candlestick formations, and filter out the low-probability setups that trap retail traders every day. We'll also cover the essential rules every order block must satisfy before it deserves your attention, along with real chart examples that show these concepts in live market conditions. By the end of this lesson, you'll have a clear framework for identifying high-quality institutional zones and incorporating them into your trading plan with confidence. So make sure to give this video a thumbs up, and if you're new here, subscribe to the channel. See you after the intro. Let's get started. What is an order block? An order block refers to the zone corresponding to the last bullish candle before a sharp and substantial downward movement that generates a valid break of structure. Similarly, in the bullish scenario, it refers to the area corresponding to the last bearish candle before a sharp and substantial upside movement that forms a valid bullish break of structure. Now let's see what is the psychology behind these zones in the market. The theory behind considering these zones as potential reversal areas is based on the belief that they represent manipulation areas formed just before a significant market movement. Traders view these zones as areas where a large number of buy or sell orders have been executed. Therefore, by using these zones in our trading strategy, we can potentially take advantage of the high probability of price reversal and change in direction when it reaches these areas. Now let's proceed to the next topic and discuss how to identify a valid order block in terms of candlestick patterns and see the various scenarios that we might encounter on the chart. In a bullish scenario, a candlestick-based order block refers to the last selling candle before the price starts pushing upward drastically. This candle typically breaks below or effectively sweeps the liquidity of the lowest point of the previous candle. For example, in the bullish diagram, we identify this red candle as a valid order block. It serves as the last bearish candle before the price initiates a drastic upward movement, having taken out the lowest point of the previous bearish candle and effectively swept its liquidity. Similarly, in a bearish scenario, a candlestick-based order block refers to the last buying candle before the price starts pushing downside drastically. This candle typically breaks above or effectively sweeps the liquidity of the highest point of the previous candle. Now let's move into essential criteria and rules that we need to consider to identify valid order blocks in the market and understand how we can use them to our advantage. It's crucial to note that to have a confirmed and valid order block, the following 4 rules apply. Rule 1. Liquidity sweep. Firstly, price must take out and sweep the liquidity above or below the previous candle to form a valid order block. Rule 2. Imbalance/inefficiency. Secondly, price must leave inefficiency behind and generate imbalance near the order block area. If there is no proper imbalance between the subsequent candles, then the identified order block cannot be considered valid. Rule 3. Unmitigated zone. Rule number 3. It must be unmitigated. Order blocks are considered one-time use, meaning we focus on the trading opportunity when price first enters an order block. Once an order block has been mitigated, we do not consider it as an area of interest for future trading. Rule 4. Market structure shift. Rule number 4. It emphasizes that a high-quality order block must lead to a break of structure or a change of character in the market. Break of structure and change of character are essential signals that indicate whether the market will continue in its initial direction or will experience a reversal. To solidify understanding, visualize a scenario where bearish momentum halts and a weak bullish candle appears before a strong 3-candle upward movement. This weak candle is a valid order block as it sweeps liquidity below the previous candle. As mentioned earlier, without a proper imbalance in the subsequent candles that form after the order block, our identified order block cannot be considered valid. If we look at this three-candle sequence, we see that the upper wick of the first candle and the lower wick of the third candle do not overlap the whole body of the middle candle. Here, we have a gap between the candles representing the imbalance. Similarly, an uptrend may pause with a red candle that sweeps liquidity, leading to a new, strong bullish impulse. By confirming a clean gap between these candles, imbalance, and the liquidity sweep, we identify a valid, unmitigated zone for potential reversal if price returns to that area. The price formed another bullish movement. However, this candle does not represent a valid order block because it did not take out the previous candle's low. Consider another series of candles as illustrated in the second diagram. Once again, we see that the price has taken the low of the previous candle, effectively sweeping liquidity below it with a bearish inverted hammer candle. This gives us a potential candidate for a valid order block. However, there is no noticeable imbalance among these three candles, and the order block is mitigated by the upper wick of the subsequent bullish candle. Consequently, this order block cannot be considered valid as it fails to meet the necessary criteria, meaning it cannot be utilized as a demand zone. When faced with scenarios where the price has taken out the liquidity from the previous candle, but the order block is mitigated, or when the price fails to create inefficiency, we designate the subsequent candlestick as the valid order block. In this case, we identify the bullish candle as the valid order block instead of the previous selling candle. This decision is based on the fact that the price has generated a proper inefficiency or imbalance immediately following that bullish candle. Looking slightly higher, we notice another instance where the price takes the low of the previous candle, effectively sweeping liquidity below it with a bullish candle before pushing significantly higher. However, because there is no discernible imbalance and the order block is mitigated by the upper candle's wick, this area cannot be regarded as a valid demand area. Continuing upward, the price pushes significantly higher again. A red candle represents the latest bearish candle formed just before the price started to push dramatically higher. It is evident that this bearish candle surpassed and effectively swept the liquidity below the previous bullish candle. Because the price also created a proper gap between these three sequential candles without any immediate mitigation, all the criteria for identifying a valid order block have been met. Consequently, we can now regard this candle as a valid order block. These concepts are universally applicable to bearish markets, across various time frames, and on any price action-based chart. Let's move to a live chart and apply everything we've learned. In this example, the overall market is clearly trending upward. The first thing we identify is a bullish break of structure. Once structure has been broken, our focus shifts toward finding the institutional order block responsible for that move. Several bearish candles appear before the expansion. However, not all of them qualify. The first candidate swept liquidity but was immediately mitigated. That eliminates it. The next bearish candle also appears promising. Again, after closer inspection, we notice that it too has already been mitigated. If our identified order block is mitigated by the last candle of the three sequence candles, we should consider the next candlestick as the valid order block. Therefore, this candle serves as our valid order block. Let's continue. In the following sequence, we see that the price has initiated another upward movement, and this candle is the last bearish one before the upward push. It has taken out the low of the previous candle. However, upon highlighting it, we see mitigation with the wick of the third candle mirroring a scenario we discussed earlier. Consequently, we identify the next candlestick as the order block. Yet again, it is mitigated, this time by the upper candle wick. Therefore, we proceed to the next candlestick. The red hammer that follows is our valid order block. Price doesn't always react immediately. Sometimes the market pulls back into an order block, produces only a minor reaction, and then continues moving. This doesn't necessarily mean the order block failed. Professional traders wait for additional confirmation. One of the most effective confirmations is an inducement sweep. Institutions frequently remove nearby liquidity before allowing the market to move in the anticipated direction. Waiting for inducement dramatically improves trade quality and helps filter out false reactions. Patience isn't hesitation. It's confirmation. The complete sequence. As the market continues developing, price eventually sweeps the inducement level before returning to our validated order block. This time, buyers step in aggressively. The market reverses. Momentum shifts. Price begins a strong bullish expansion. At this point, every piece of the puzzle fits together. Liquidity has been collected. Structure has shifted. The order block remains valid. The inducement has been removed. Now, the probability of a successful trade is significantly higher than if we had entered on the first touch alone. This is the difference between simply identifying an order block and trading it with institutional precision. Finding an order block is only half the job. By now, you know how to identify a high-quality order block. But identifying the zone alone isn't enough. The way you enter the trade can have a major impact on your win rate, your risk-to-reward ratio, and your long-term profitability. Professional traders don't all use the same entry technique. Instead, they adapt their entries based on market conditions, volatility, session timing, and the size of the order block. Let's explore the 4 primary entry models that can be used when trading order blocks. Entry Model 1, Wick Entry. The first approach is known as the wick entry. Once you've identified a valid order block, place your pending order at the extreme wick of the candle. For a bearish setup, the buy limit is placed at the lowest point of the wick. For a bullish setup, the sell limit is placed at the highest point of the wick. Your stop loss should be positioned just beyond the opposite side of the wick, allowing a small buffer for market spread. This entry method gives price maximum room to move before invalidating the trade. As a result, it's often considered the safest entry technique. However, because the stop loss is wider, the overall risk-to-reward ratio is usually lower. The advantage is that price frequently taps the wick before reversing, increasing the likelihood that your order will be filled. If your priority is consistency and a higher execution rate, the wick entry is an excellent choice. Entry Model 2, Body Entry. The second method uses the candle's body instead of its wick. Rather than entering at the candle's extreme, your order is placed at the open or close of the order block, depending on the market direction. The stop loss remains beyond the wick, but the entry occurs much closer to the center of the candle. This tighter entry naturally reduces the size of your stop loss. A smaller stop means a better reward-to-risk ratio. The trade-off is execution. Sometimes price only touches the wick before reversing. If that happens, your body entry never gets triggered, and you'll watch the market move exactly as expected without you. This is the balance every trader must consider. Higher reward often comes with fewer filled trades. Entry Model 3, Midpoint Entry. This is the entry model I personally prefer because it offers an excellent balance between probability and reward. Instead of entering at the wick or the candle body, divide the order block in half. Place your entry at the 50% level of the entire candle. Your stop loss still remains beyond the opposite side of the order block. This creates a tighter stop while maintaining a realistic chance of execution. Many institutional traders believe that the midpoint represents the fairest value within the order block. When price retraces into this area before continuing, it often produces exceptional reward-to-risk opportunities. Although not every retracement reaches the midpoint, the trades that do can generate significantly larger returns than standard entry methods. This is why many advanced smart money traders favor this technique. Entry Model 4, Aggressive Entry. The final method is the most aggressive and the riskiest. Like the body entry, the order is placed near the candle body. However, the stop loss is tightened dramatically and sits very close to the order block itself. This creates an extremely attractive reward-to-risk ratio. But there's a catch. Markets rarely reverse with perfect precision. Small fluctuations are normal. A slightly deeper retracement can trigger your stop loss before price moves in your intended direction. For that reason, this entry model requires excellent timing, strong market confirmation, and disciplined risk management. It's generally best suited for experienced traders who understand market behavior and are comfortable accepting a lower win rate in exchange for larger potential returns. Choosing the right entry. There isn't a single best entry model. Each has strengths and weaknesses. The right choice depends on the market environment, the size of the order block, current volatility, and your personal trading style. Conservative traders often prefer wick entries because they prioritize execution and consistency. Balanced traders may favor midpoint entries for their combination of precision and reward. Aggressive traders might choose tighter entries to maximize returns, fully accepting the increased likelihood of being stopped out. What's important is consistency. Use the same rules repeatedly. Track your results. Refine your execution over time. Professional trading isn't about finding the perfect setup. It's about executing a proven process with discipline. Final thoughts. Order blocks are one of the most powerful concepts in smart money trading, but only when they're understood correctly. Most traders lose because they treat every strong candle as an order block. Professional traders understand that valid order blocks tell a much deeper story. They begin with a liquidity sweep. They create imbalance. They remain fresh and unmitigated. And they produce meaningful changes in market structure. When those conditions align, the probability of success increases dramatically. But remember, an order block is never a guarantee. It simply provides a high probability area where institutional activity is most likely to occur. Combine order blocks with market structure, liquidity analysis, inducement, proper risk management, and patience. Over time, this combination can dramatically improve both your decision-making and your consistency as a trader. Conclusion. That brings us to the end of this lesson. Today, you've learned what order blocks are, why they form, how to identify valid institutional zones, how to avoid low-quality setups, and how professional traders execute high-probability entries using them. Now it's your turn to put these concepts into practice. Open your charts, mark recent liquidity sweeps, identify fresh order blocks, and start analyzing price through the eyes of institutional traders. The more charts you study, the more naturally these patterns will begin to stand out. Thank you for watching. If you found this lesson valuable, be sure to subscribe for more advanced smart money concepts, institutional trading strategies, and professional market breakdowns. Until next time, trade with patience, stay disciplined, and I'll see you in the next lesson.